Good evening. This is Doc Severson for the Theo Night Report for Thursday, May 10th. All right, in Tuesday night's report that I recorded, I talked to you guys about the fact that we had a lot of energy sitting here, a lot of energy at the weekly and the daily time frames, and that we should expect to see a big move. So that was also in conjunction with the fact that, as we've been talking about lately, that the realized volatility has been outrunning the implied. So when the realized volatility outruns the implied, the expected moves that we set up for the week, so these are the weekly expected moves. This was front week. And then we also, this past weekend, I calculated the back week expected move. So these are the expected move for next week, which is the 18th. Well, guess what? 1, 2, 3, 4 days, and we're now hitting the expected move for the back week already. So we blew through Friday's expected move for tomorrow and already tagged the next week's expected move. So this happened last week as well too. So last week we started off, I guess it was right around this level here, and we tagged through the back week expected move to the downside. And now we've reversed, and the exact same thing is happening. This time to the upside. So what does this mean? What does this mean for going forward? Well, we're still in this large consolidation pattern that we've been in really since the end of January, early February. But right now, what we're starting to see is a potential break to the upside. Now, this is also coming into the same spot where we have not only the overhead resistance from that back week expected move, but also this trend line. So while this does improve the probabilities that we'll see at least a short-term break from this level and above the trend line, there's no lack of energy to support this break. But it's what happens after that break. If the break does come, and right now we have printed a higher high, so it doesn't even have to break. So what happens next is so important for the market. So one of two things will happen at this point, based on what we've seen in the recent past. If we see the price consolidate up in this range with a small triangle, perhaps, maybe even a little bit more of a flag, which would be sort of a drifty pattern back down, this is actually bullish, and it would support an eventual break to the upside, even if it turns into a lower high down the road. Again, let's not get too far ahead of ourselves and try to predict what's going to happen through the end of the year. All we care about is what happens over the next couple of weeks here. So if we have kind of a drifty move down like this and it consolidates at that level, that's actually a fairly bullish pattern. We could still get more green candles and a breakout above the trend line. That could certainly happen. But right now, I think this would be a good place to pause as we get into the weekend. Now, on the other hand, if we see something like this occur, if we see similar to what we saw recently, reversal candles up here, especially a key reversal bar where we have a higher high and a lower close below the day's range of today, which would be an incredibly bearish candle, but any kind of reversal candle followed by follow through to the downside. If we start to see red candles printing to the downside, then we're going through yet another one of these swings that's getting everybody thrown overboard, as these swings are just reversing on a dime, So most people's swing trades are just not working out lately. I've talked to a lot of people saying, why are these swing trades just not working? Well, because none of these swings are extending right now. Everything is just a range. But again, within the context of that, we're going way beyond the expected move of the week. So let's watch and see what happens next, whether or not the price consolidates and then starts to rip higher from here, or just outright reverses. We ought to know that by early next week as to what is next in store for us. So while I'm still talking about this, this is a good time to kind of bring up the whole notion of the pain trade. Now, the pain trade, what this means is that as the price, well, first of all, when we have any kind of correction like this, there's a natural bias to the downside. There's a natural bearish bias to the downside because the market was screaming higher to begin with, And anytime we have these big moves to the downside, there is just this very natural bearish bias like, okay, here it comes. It's 2008 all over again. We've been waiting for 10 years for this to happen. It's finally here. And so everybody does get quite a bit bared up in these things, and especially when we have candles that undercut the previous lows, it's very, very easy to get extremely bearish, as well as the fact that every financial publication that's out there, you start to look around at some of the news. We have, a lot of geopolitical unrest. We have potentially rising interest rates. We have a Fed that's not quite sure what to do because of all the debt that they carry. Yeah, sure, there's a lot of bad news that's out there. There's a lot of uncertainty. But unfortunately, little of that has anything to do with the price of the market. And this is why you almost have got to turn off the news, stop reading all the financial websites, because all they're going to do is report the same news that everybody else is going to trade off of, and that is not going to provide you with an edge. In fact, quite the opposite. So the pain trade comes when everybody leans in one direction, and then the market does what the market does best, which is inflict pain upon the masses. So all the market has to do is to figure out, okay, where are the majority leaning? And as of last week, the majority were leaning to the downside, weren't they? But what did we see? What did we see that we ended the week on? We saw this candlestick here, which is about as close to a hammer candlestick as you're going to get. And then followed up by this candlestick here. What is that? That is a bullish engulfing pattern. What does that tell you about where the price is going? Now, a lot of people would look at those two candlesticks and say, well, yeah, but it was really negative last week. It still just didn't feel right. And this is where people are making decisions with their feelings again and shorting something like this and expecting the price to roll over again. And this is what happened was we got the pain trade over the last 2 days. The market caught everyone leaning towards the bearish direction, and it just took out and kneecapped them. So does that mean that we're going to head higher? Well, the same exact thing could happen into next week. Starting tomorrow, we could start to see everybody lean too bullishly and, get dragged underwater again. So this is why I'm saying the next few days is going to be very, very important based on how, if and when this consolidation sets up, and if it breaks higher from there, or whether we get the same reaction that we did a few weeks ago where it just stops and reverses. Stop and reverse is the name of the game right now. So the trade that's working right now in this environment, now it's not going to work forever, but what works right now in this environment is to buy these long condors. We're setting up the spreads, essentially centering the vertical spreads, the vertical debit spreads at about 1 standard deviation or the expected move. I'm typically going out about a week. So I'm going out about the back week. And so this past Monday, I set them up for the 18th. So that's just a little, a week and a half or so for the trade duration. You can make them shorter, but you've got to have a big, big move in that 5 days. So again, starting on Monday, what I would do is I would center the trades in the back week at around this strike and this strike. And then we take off the trades as the price gets to that point, or at about 200% return for that. And what that does is that pays for the other side. Now, what's odd is that last week what happened was we made the play to the downside. We took off the put spreads for a profit, and I held the call spreads. And today I took off the call spreads for the 11th for about break even. Perhaps could have held them a little bit longer and made a nicer profit on there, but still just the fact that I've got the call spreads paid for was not something that I anticipated. So taking these off at 200% profit means that I could let the other side just expire. So these are ways that you can play these things. So right now the long condor is the weapon of choice for me in this market. That's it for today's report. Thanks for listening, folks. See you tomorrow.